our next guest, though, talk about the Fed rate cut decision that we have coming up and the potential for a Santa rally and if it could be derailed by the decision today. Joining us now, Jeffrey Small, partner at the Retirement Income Source. Jeffrey, thank you for being with us today. You know, it is Fed Day. It's finally here. I'd love to know, just to start, what are your expectations for what we are going to get at 2 p.m. today and also what we might hear in the press conference afterwards?
Well, I'd expect the hawkish tonality to continue, and there's still a chance we may not get a cut today because we're missing data, and the Fed has suboptimal economic perspectives right now, despite the declining job environment. And so, you know, there is a good chance that we'll have a quarter-point rate cut, but nothing is guaranteed at this point. If it's hawkishness, I think this is a sell the moment or sell the news event, and we'll see the market begin to sell off as bearishness has been creeping in all morning in anticipation of Jerome Powell acting as the third year as being the financial Grinch in December. He has, you know, kind of spoiled every Christmas tree rally, every Santa Claus rally we've had so far. And so I expect that tonality to continue at this time. But we just need his heart to grow a little bit, Marley. If his financial heart could grow and he could lower rates, boy, what a gift that would be for the American consumer, you know?
So if we get the rate cut, you're one of the first guests who's actually brought up the possibility that we have no guarantee here. Yes, it is 90% factored in, and most people are expecting it, but there is no guarantee we're getting a cut today. Let's assume that we do. We do have several people who've brought up to me the possibility that we may see a different Jerome Powell today than we normally see because he's on his way out. Do you think there is a possibility that we don't get what you call the Grinch Powell and we get a more open, more vocal Powell, because at this point he really has nothing to lose?
Well, there's always the chance for anybody's heart to grow if they're used to playing the Grinch, right? Because nobody wants to be categorized as a Grinch. In this case, though, I say there's very little chance that's going to occur. I think he continues playing the Grinch financially in December like he has in the prior Decembers. And he's not going to be very dovish. He's going to be very hawkish. That's going to create more bearishness on the market. And I don't think a quarter-point drop is really going to do very much for the rate environment anyway, because the market has its own ideas. The credit markets, the rate markets have their own ideas right now. Despite the Fed, they've been dislocated, you know, for the last 18 months. And so the Fed lowers rates and rates go up. And so I'd expect that trend to continue because there's a lot of other influences affecting rates besides the Fed, who appears to be very what I would say behind the curve and somewhat predictable at this time.
All right. So one of the other things that we're talking constantly about through this December seasonality and also over the last month is this potential for an AI bubble. I'd love to get your thoughts on that. If you think, one, those concerns are warranted, two, if you think they're going to continue, and how that impacts us into the end of the year and into 2026.
Well, we've all heard for the last 3 months nothing, you know, but the word bubble about 100 times a day. And so there's a huge difference between the 2000 bubble and today's bubble, where companies are actually making money and there's no threat of companies running out of money. And that's really what precipitated the 2000 collapse for the great, you know, dot-com bust. And so I think going forward, AI has got a lot of traction. Companies like Nvidia are grotesquely misunderstood. They're more of a long-duration AI utility rather than a cyclical semiconductor name, and they're being treated as a semiconductor name at this time, where valuations in Avago and AMD are much higher in terms of their metrics than NVIDIA's are. And so, you know, that's just one example. But I think the long-term utility of AI is here to stay. The projection in job decreases the next 5 years is around 18 million from the advent of AI, just domestically speaking, globally 45 million people. So AI is not going anywhere, and it's time for folks to realize that and stop treating NVIDIA like it's like a typical semiconductor play, because it's not.
All right, so let's talk about Nvidia. You say that it's grotesquely misunderstood. Right now, its PE is in the low 30s, which is lower than Microsoft, Apple, Amazon right now. What do you think the disconnect is there, and why do you think Nvidia is so misunderstood?
Well, we've never had a market cap this big, and quite frankly, it freaks out investors in terms of what could go wrong. And, you know, a lot of the naysayers, especially some of the very famous people on Wall Street, have been waiting for that negative quarter to come, and it's never happened. You know, when's a competitor going to come out and unseat them? When are they going to have some demand? But I mean, Nvidia's ramp rates here are ridiculous. You know, they'll run about $213 billion for this year in terms of total revenue. By 27, will be around $316 billion. Their free cash flow will improve from $80 billion to about $120 billion by 27. And I think you've got to utilize this opportunity as a buy the dip moment and realize they are a long duration AI utility play, as they really are the AI Bible, so to speak, for lack of a better metaphor here, or connection to them. And so I think you've got to get on board.
So would you say Nvidia is your number one pick in the tech space then?
It is absolutely my number one pick in the tech space right now. Not to sound like Dan Ives, but, Jensen is the godfather of AI. That trend will continue, but the entire semiconductor sector will benefit as well as money continually gets reinvested in the direction of this new tech.
And who else do you like in the tech space?
Well, I think, the biggest AI play, and we've heard about this for months, and I apologize for saying the same story, different day, but Tesla is the biggest AI play right now in terms of their autonomous robotics, and of course, their autonomous driving. And so that is really the biggest story here. If those things come to fruition, that's a couple $1 trillion of extra market cap added over the next 3 to 5 years to Tesla. Puts it in the same neighborhood or category of valuation potentially as Nvidia as time marches on here. But a lot of this stuff has to materialize. And so if you're looking for, where is the big growth going to be coming from in the Magnificent Seven side of the equation, Tesla has the most upside growth at this time. But that means they also have the most upside risk because it is trading at 209 times earnings present moment.
So you've got some major mega cap AI names there in Tesla and Nvidia. How do you balance conviction here with your concentration risk?
Well, I think the proof. You try to use proof if you can, as much proof as possible. Marley, we only have to be right 60% of the time in our industry to be successful. And so nobody knows for certain. But I think, you watch what the company's doing, you see how they're trending and see what's happening. And hopefully there's no bad news that are making progress. And so if we're sitting here in 12 months and the robo-taxis in, 25 cities nationally, we're looking at a $600 minimum stock price on Tesla. And so, of course, we're looking for the expand side on the equation. And of course, the advent of, the robotics coming to the equation, coming to market over the next 12 months.
And Jeffrey, you're mentioning a lot of long-term plays here. So for my last question, if we were to sit down a year from now, what do you think will have been the biggest surprise in the market narrative?
That tech is leading again. Unfortunately or fortunately, that's the same story, different day. That tech is going to lead the market. The concentration is going to get larger. The rest of the market contagion will catch by way of the advent of their integration of AI into the different sectors, and tech will improve the profitability of all of these. And so those two are directly correlated. And I think it's very important for folks not to realize that those are not disconnected at all. Those are connected. And if the broader market does decide to catch up to tech, the reason for that will be the enhancement of profitability from tech itself in AI. And it will reshape our economy, and it'll reshape the rest of the publicly traded companies in the S&P for the ones that embrace it.
Well, Jeffrey, we appreciate you being with us to talk through all of this. That's Jeffrey Small, partner at the Retirement Income Source. And we've got plenty more to come on Trading 360.